Good morning. Today is Monday, October 13th, and today's Columbus Day or Indigenous Peoples Day. So even though banks are closed, the mortgage and bond rates markets are still open. So any movements can still show up in pricing today, just for your knowledge. But mortgage rates on Friday is some good news. So they ended at their lowest levels since the last Fed meeting. And of course, this is the one where rates rebounded in the wrong direction immediately after the announcement. Even though the Fed didn't directly cause rates to rise, the markets reacted poorly at the time. So hitting those lows again is a good signal for buyers. So take a look here. This is 1 year, last October to this October 10th, at least. And you can see right there, we hit basically year lows. So we're kind of hanging around 10-month lows now, but we're doing really good. So, you know, these are really positives. The biggest thing looking ahead is the Fed meeting, but the other thing is this government shutdown. So the next Fed meeting is scheduled for November 6th and 7th. So that Wednesday will be the decision where we find out if they do cut the federal funds rate or not. There's speculation about whether we'll see another cut, but the markets aren't really convinced yet. So the jobs report, that October 3rd jobs report, was really important, but it's been delayed because of the government shutdown. So we haven't seen it yet. Investors are essentially flying blind and just reacting to anticipation more than actual data. So that's kind of what you're seeing with rates right now. They're stabilizing rather than spiking or dropping sharply, while traders wait for direction. And just a reminder, those rates from the Fed don't just drop because of a federal funds rate cut. They drop in anticipation. So when the market believes cuts are coming. We saw that last year. We saw that again already this year. Rates improved before the Fed made a move and then actually ticked back up after the cut. So bottom line is momentum is on side of buyers right now, but volatility is still in the background until the numbers come out and give everybody what they're looking for to kind of push forward. So averages you're seeing here, still pretty good. We'd love to see them come down, obviously. Still hanging right around the 5%. Hopefully start to see a 5 here on these numbers for FHA, VA, government loans. USDA loans right now are one thing that is affected by the government shutdown. So if you want a USDA loan, they're not going to be originating any till the government opens back up. These, though, FHA and VA are running as anticipated, or as business as usual, I should say. And then, your 30-year fixed, 15-year fixed is still really competitive. So we're getting there. And then, of course, the Treasury, that's what everything most closely lines up with in terms of mortgage rates. And we've been saying it for a while. If we want to see some rates in the 5%, this number right here on the 10-year Treasury needs to be a 3. Even if it's 3.999, that's going to be huge to break that ceiling of the 4 where we've been for a while. So the markets are, going to find out what's going to happen here. Government might open back up. There's things going on in the world. Anything could change anything at any given time. But right now, momentum is on the buyer side. So today we want to highlight again, this is why working with a broker really matters. Big banks and retail lenders, they're stuck with overlays and fixed internal pricing. I am able to shop wholesale lenders and structure deals around timing, concessions, loan programs without being boxed into just one option. So as an example of this, you might have heard something called non-QM out of lenders these days, or see emails with that language. Non-QM is non-qualified mortgage, or just think of it as just a non-traditional way of underwriting a loan to get a mortgage. You've probably heard of bank statement loans, where you can use deposits that are calculated for your income instead of using a pay stub or something like that for your debt to income ratio. But did you know, in addition to all that, you could use your total assets. So that's including retirement accounts, things of that nature, stocks, stuff, anything at all, accounts, assets, as a way to get qualifying income. So we can add that all up and come up with the debt to income ratio that way and give you extra options and extra ways of being calculated. So if you have anything at all unique to your situation, brokers like me are going to be your friend and work with you to find a way to say yes. So if you need a rate lock strategy, a creative structure around seller credits, or just flexibility on guidelines to help you get approved, I can move between lenders to make deals happen. So that's the power of the broker, the whole broker channel, and why now is really a great time to leverage while rates are soft and inventory is sitting. So have a great week, and we look forward to hopefully having you like and subscribe to our channel, share this information with your friends, and just continue to get more momentum with the business here at Clubhouse as we expand. And then, of course, just in the markets for our clients, it's starting to look really great. So everyone have a great week.